how you're providing value to your clients. Because yes, you do mortgages, but you also do equipment financing. You do HELOCs for operating loans. Like, do you see a shift in trends of the types of financing you are giving to people, and why?
Not as much on my own portfolio client, because we do have portfolio clients, but more of an observation
Generally.
of general. I would say there's a shift towards e-commerce during COVID, but the interest on e-commerce has kind of slowed down.
Yeah, we're seeing the exact
Since
same thing.
post-COVID. Also, there's a shift more away from the retail service sector to other more of supply chain sector. In the sense, your typical mom and pop restaurants prior to COVID are doing quite well. Now, some of them are still doing quite well, even better than before, but there's a divergence of those middle of the road mom and pop service providers. They're not doing as well now. So that's what I'm seeing.
Yeah, but there's a proliferation in other commercial asset classes. So,
Exactly.
so the restaurant now, on a price per square foot, that value has come down. But like, if you ever price out a piece of industrial property on a price per square foot basis, or like warehousing as an example, and you might have some experience with that as well, like those have taken off,
Yes.
right?
Well,
And again, you said it, it's e-commerce.
right. They've taken off during COVID, but they've also kind of, because there's another piece of additional change, which is the interest rate, right? With the 4.5 or 4.75% increase in interest rate now, the ability to lend on the same kind of cash flow has been restricted significantly.
Yeah.
So as a result of that, the pace of increase in real estate pricing on industrial even has kind of slowed down, or has normalized. It was like this, for the last, from 2019 to 2022, I've seen people that double their asset
So
value.
you're saying the loan amount, for example, the financing amount stays the same
It
because
has even reduced.
reduced, right?
Right.
Yeah,
It
but
is
not
reduced,
increased.
because you
Okay.
need to reduce it.
Yeah.
Right, because
Well,
the interest rate has increased.
Exactly.
Let's talk about leverage, and I'll jump in. So Aaron Cameron, I run the operations at First National. I'm on the credit side of the business, and so I'm kind of negative Nancy when it comes to a lot of this stuff. So as Lawrence was talking, like, I don't know if I agree with that. I'm not sure that's true, but that's just my nature, right? I say no to a lot of business. And only approve the business that comes from guys
only
like
approve
Equiton.
Equiton.
I mean, I was trying to look it up. I can't find the numbers, but it's got to be like half of your apartments are financed through First
Yeah,
National.
pretty much.
Huge partners, right, between us and Equiton, and we love what they do. A couple of things that he had said that I thought were interesting that just add to the leverage concept. He grabs the investment from the equity side, invests in the building, gets leverage, collects the rent, pays me first, and then pays you back, right?
Yes.
Like that's how that works, right? And so let's go to leverage and the importance of leverage first for your business, right?
Yeah, for sure.
And so you were showing the different yields you were getting. Let's just focus on the apartment one because that's the easiest because those are
it's the
cash flowing assets, right? So you're raising funds to buy. Let's make it really simple. You're buying a $100 million, 300 unit, 200 unit tower, right?
Yep.
And so you need 30 million in equity, 25 million in equity, and how do you kind of make the assessment of how much equity you need and what leverage points you want?
Yeah, so there's a lot that goes into that, but by and large, we care less about the loan to value of any one acquisition, and we care much more about that single acquisition's loan to value relative to the portfolio as a whole. So let's just say one thing about loan to value. Loan to value is the percentage of the property that is leveraged, right, relative to the value of the property. At Equiton in the Res Fund, we're at a loan to value of about 46.3%. So let's just call it 50%, right? So I'm more inclined to take on a loan to value of 80% on a given acquisition if I know I have 15 properties sitting at 25,
Right.
right?
Are you targeting that 50%? Is that sort of the overall
Yes.
loans under admin or assets under management leverage point that you're
Yep.
comfortable with?
Yeah, we want to be around 50%. Obviously, you need to take, your seesaw image said it
Yeah,
all.
yeah.
Like, you need leverage. You can't buy a $100 million apartment building in cash. Or you can, but it's stupid to do it. Good luck with that. So you need some leverage, but also excessive leverage, we all know, can get you in trouble, particularly in a rising interest rate environment. Right?
Let's just do a capital stack example. So why don't you just kind of go through your explanation of what a capital stack looks like? Because we should talk about, I think this is just like lending 101, real estate 101, but like the reality is you've got to have a capital stack where equity is at the top, but that's how yields are derived, right? And so what's happening, and we all talk about it, just make sure we're all on the same page, the underlying bonds, which dictate mortgage rates on the senior debt or the A pieces, have skyrocketed, right? In the last 2 years, let's say the last 12 months anyway, they've gone up 300%. The last week, they've gone down 50 basis points,
Yeah.
but they were, I used the 5-year Government of Canada bond, which was at 3.5% a week ago. 3.5% was the highest it had been in 15 years, right? So the highest it's been since the early 2000s. It was down to 0.5% in the middle of COVID. So it went from 0.5% Government of Canada AAA, right? That's the 5-year Canada's bond, all the way up to 3.5. So when that happens, everything else has got to move up. And how do you account for that? How do you think about it in your mind?
I'm going to answer that with, because we use, on the commercial side, we don't necessarily use the Government of Canada bond, even
It's
though
a
we-
proxy for
it's
just-
it's a
yes.
derivative of that. But with the higher interest rate, because that's across the board, that just definitely means a lower leverage percentage. So, even though the numbers that I talked about earlier, you know, the 80% loan to value, 100% loan to value, 75%, 65%, those are based on companies' operating cash flow. But changing the story to rental, right? Because tenants, it's much harder to increase rent from residential tenants because rent controls and so many other things. Then you're dealing with a fixed rental income, much higher interest rate. What do? Your income can only support so much mortgage. So rate is higher, income the same, lower leverage. Now, the percentage of the difference, it varies deal by deal because like Lauren said, we also do look at the overall portfolio of the client.
Yeah.
So it's not just one individual piece of property or a project.
Yeah, it's important to know, like Alex is looking at the commercial, the strength of the commercial business, not necessarily the real estate, versus Lawrence and I are much more focused on the cash flow coming directly from the assets. Particularly,
more assets.
particularly in my world, it's 100%, we're a cash flow lender. Like I could care less if it's a $1 billion organization. What is the lease terms and what's the net effective rent coming out of that asset? And that's what I'm lending on, because that's the only security I'm getting, right? In theory, I'm not really getting security to the entity that either resides in it or owns the asset. We can talk about recourse, but that's another hour presentation. One of the things that's really interesting that's going on right now in our world is, as rates have gone up from the low of that 0.5, again, I'm using the 5-year Canada as just the proxy, to 3.5, now down to 3. We can maybe get into that in a second, but spreads have widened out too, and spreads are the sort of the risk-adjusted amount that banks want to earn above that risk-free rate. To use the 5-year Canada's risk-free rate, we can all go and buy bonds, it's guaranteed by the government, it's risk-free. And then we add a spread on top, right? And so that spread has actually increased, has widened also throughout this term. And that's really just reflective of reflection of the uncertainty in the marketplace, right? It really is just, we don't, as lenders, don't really know what's going on, so I just want more yield. I want a larger return over that risk-free rate. So it means that the all-in uninsured mortgage rates, we can talk about CMHC if we get there, the all uninsured mortgage rate has gone from, well, it was literally down to 2.9% at its low. It's now 5.5%. So like literally, if you're Equiton and you're buying a Amazon anchored industrial, just to use as a AAA asset, 20-year lease to Amazon, the best possible interest rate that they can get is probably 5.5% in the marketplace. Like that's the best interest rate in the commercial real estate space, uninsured, not talking about apartment buildings. So everything else needs to blow out above that. Again, if you were getting,
that's your floor.
if you were getting 2.9% on that debt before, now all of a sudden you have to increase, and this is where I'm going with this, which I find really interesting. The B pieces, the mezzanine debt, all the other debt hasn't necessarily followed. Have you found that? Because I know you guys sometimes do sort of structured finance.
Yeah, I can't speak to that amount of mezzanine debt
Sure.
and the B pieces. Maybe you would have some insight, but yeah, I don't know. I couldn't say.
Okay, so I do. So what's interesting is that the sub debt, like the second mortgages or the mezzanine lending, hasn't really expanded out, right? Like you would think that gap, the way we kind of think about these is spreads, right? So if it was 3%, and the spread to a good B piece, we call them, was 8%, it's a 500 basis point spread. So now that the A piece is 5.5% or 6%, the B piece should be 11% or 12%. Everything should move up, meaning the equity should also increase. Because if you think about the capital stack, but it hasn't really worked out that way. The underlying, the bottom part of the capital stack is just scooping so much more of the yield,
Yeah.
and everybody else is stuck, still trying to claw and scrap for the same amount.
And I think it has to do with carrying costs, because if you have mezz debt, and you just move it out because your credit spread between, on like a securitized perfect loan moves out 400 basis points. You can't just add 400 basis points to a 9%.
Quickly, you get to it quickly.
Yeah, exactly,
Yeah.
because the carrying cost of that is astronomical. You're gonna lose clients, it's gonna create like systemic risk or whatever it may do, right?
Yeah.
And so the spread's gonna have to be lower on that B and mezzanine debt, would it not?
Well, it hasn't.
It's all about carrying
It has,
costs.
well,
Yeah.
it impacts the yield on the equity, and that's kind of where I was going with it.
I actually have some
okay.
clients who are in the big business, and also there's some mortgage brokers here who can also chime in as well. My understanding is from when they're raising funds now, it actually becomes that much harder, or they have to actually promise much higher percentages
Yes.
because of the market risk
Yep.
on the underlying real estate market. So even though when Aaron said, you mentioned that you haven't seen the increase on the mezzanine debt interest rate, I can see that it's only a matter of time that it will.
Well, that's, yeah, it
I can-
has to, right?
It has
That's
to,
theory,
yeah.
because, again, remember, yields, and no matter what you're talking about, but we're talking about real estate, it's just reflective of risk, right? That's all
Yep.
it is, right? And so, the underlying A piece has increased, doubled, right? They've basically gone from 3% to 6%. So you'd think that everything else has to move up, including the equity, right? Like, in theory, if you're used to be getting a 20% return, I would like to believe if everything stays the same in the future, which is not true, but imagine a world where
Yeah, all
everything's
things
exactly the
equal.
same today. In 5 years from now, the yields that Equiton's promising have increased,
Yeah,
right?
they should.
They should.
Because as an equity holder, you're going to demand a higher return because you know that you can do a MIC that's gonna give you a higher return. So the whole capital stack sort of moves, right?
Yeah, the real estate is so slow, it takes a long time, and that's kind of the
Which
world
isn't a
we're
bad
in.
thing, in my
It is,
mind.
no, but that's the uncertainty that we're in, which makes everything so complicated. Yeah, go ahead.
Just wanted, yeah, that's actually what I was going to ask about the risk premium there. You're talking about the credit risk. But from my understanding, in 2008, when like what happened is like both the bottom layer A lenders, the B lenders, supposedly traditionally the A lender have less risk, and as you go up, you require more return. But it seemed like in 2000 when credit was dried up, essentially all the risk became very similar, A, B, C's. And then my thought to that is, on the B and C level, essentially because the speed of increasing interest was this fast, essentially if you're on the B and C level, the A has the first right of recourse. So therefore, if you're on the B and C level, you essentially cannot drive up the same speed to really kill
Yeah,
the
no, I think
kill
that's
the
exactly
person.
right.
So this is the problem, is that the primary gets the benefit of
It
getting
does,
the
because
increased
if you're B
yield.
or C, to your point, now if you're the lender, you're
Right.
taking asymmetric risk.
Right.
Because you're not seeing the same incremental return, because
Right.
you can't push higher rates, but you're still third in line in terms of claim on asset, right? If you're mezz debt, A goes first, B goes first,
Correct.
then you.
So that's my
right?
question, that what do you think about in the future coming up? I mean, if they come down, for example, that could be potentially because, I mean, the likelihood is because that we potentially are heading into a recession, need some type of stimulus or some type of support. At the same time, we're facing a problem, which we're seeing right now, is that the prime rate coming down potentially, but at the same time, the credit risk premium is still there. So the bank is not willing to potentially follow through as we progress in there. At the same time, we're facing potential recession. So how do you feel you would do, especially in maybe the apartment area, space, how do you feel you can weather that storm when recession is happening, but potentially at the same time rate is not coming down as fast, and we're continuing this path in the future?
I can speak to how Equiton approaches credit risk. Did you want to chime in?
No, go ahead, I got
Okay,
something else.
so one of our tenets of the apartment fund, as an example, is it's meant to be a super consistent investment. Like, we value profitability on an even keel to downside protection. Like, we take a lot of pride and we work hard in keeping that thing never dropping in value. One of the ways we do that is by managing credit risk, and one of the ways we manage credit risk is most of the mortgages we underwrite, and you can verify this, they're 10-year fixed, right? So we lock in a credit, or not a credit spread, but an interest expense from day one when I lock in that 10-year. Now, I'm paying a higher interest rate up front in exchange for that fixed rate, but I'm happy to lose a few percentage points of profit in exchange for that predictability. Because if you own one home, you're gonna kind of YOLO it on a variable rate mortgage. You know, interest rates are at 2% now, why not? If it goes up to 4%, your payment goes up $1,000. If we did that, our payments go up on a monthly basis, hundreds and hundreds of thousands of dollars. We can't take that level of risk with 8,000 of our clients' capital, right? And so we lock in as a 10-year fixed in many, many cases. Now, the reality is there's instances where we wouldn't do that, but I think that's beyond the scope of the conversation. But that's how we sort of approach that, right? Predictability becomes very, very important.
Knowing if you're investing in that side of the business, knowing the professionalism, the sophistication of the group that you're investing in. I mean, we'll use Fortress as an easy
Yeah.
example, right? They're out there selling the same concept, promising 8% return, but you were at the very top of the capital stack, and they were making 30% return on their equity, and you were basically taking on a totally outweighed risk for your return at 8%. And that's a good example, right? Is that, you know, if you can invest in a Government of Canada bond for 3.5%, you're surely not going at the very riskiest part of a development for 8%, right? Like that doesn't add up. And so that's the logic, is that 8% should now be 15%, but it hasn't necessarily made sense.
Hasn't trickled up. And for those of you that don't know, Fortress is another alternative investment firm that, in short, took some pretty risky credit facilities on and it went bust.
Yeah, there are, I mean, to be fair, Equiton plays in a space that doesn't have the best reputation.
No, for
because
sure.
of
There's a
Fortress.
graveyard behind us
Yeah.
of companies that have come and gone.
And they do it properly, and they have the professionalism and are taking on the right approaches. So one of the reasons we're investing, we're partnering with them. Yeah.
And this was not arranged. I literally.
We just met. Swear to God. Where do you want to go? Do you want to go to cap rates? Because there's something else Lawrence talked about, and I'm sorry, I'm gonna
no, it's
contradict
okay,
you.
it's
But
okay.
he showed that line of apartment values never going down, and they're going down, people. They're going down right now, fast and furious. At least they have been. And that's just a result of this cap rate to interest rate spreads. It's the same concept, right? That a cap rate is really quickly the unlevered return on an investment, right? Like it's a really simple NOI cap rate equals value. So when you buy a building and it's got a fixed NOI, your yield is the capitalization rate, unlevered.
Yeah.
And
Not
then-
including debt.
Right, not including debt. And so cap rates have to be above interest rates. Like they just have to be. And I don't know if this is lending 101. I hope people are following along. When you buy a property, your capitalization rate, your unlevered return has to be greater than the interest rate you're going to take. If
You
you
would
don't,
like it to.
no, it has to be.
You would like it to.
Yeah. Well, or
There's
else the
people who
investment
doesn't
doesn't
do
make
that.
sense. Yeah,
Yeah.
You're hoping for capital appreciation at that point. You
Yeah,
take a
it's-
1% cap
Traditionally,
rate.
that is the case.
Well,
but
so I'm a cash flow lender, so in my world it absolutely has to.
Yeah.
There are outside, circumstances, fast rising rents, capital appreciation. I mean, there are motivations for why you'd want, but the reality is, if your interest rate is below your capitalization rate going in, you're losing money on day
Yeah.
one. Like your cash flow is negative, right? You have thoughts about that? How do you guys play with that?
Yeah, for sure.
Scale.
So one of the things that we do is we try and create diversity across our portfolio. So as an example, I told you guys that we bought 2 properties in Alberta. We bought them because their cap rates are much higher. They're cash flow producing investments. And so we want that mixture of lower cap rate but maybe higher capital appreciation buildings with maybe lower capital appreciation but very immediate strong, healthy cash flows, right? Again, the key here is balance, right? We're building a portfolio for our clients, and so we need elements of both. But one of our strategies at Equiton that makes it as successful as it's been, and frankly why it's never dropped in value, is we employ a value add strategy. So a value add strategy, for those that don't know, is you're targeting assets with what we call a gap to market. So that simply means a building, you take a triplex, right? One of you guys goes out and sees a triplex. It should be performing up here. It should be bringing in $3,700 a month. It should have nice clean landscaping, fresh plumbing, no knob and tube electrical, blah, blah, blah. But for some reason it's down here. And there's many reasons why that may be the case. Maybe the current owner occupier or owner operator is maybe a little cash constrained, so the landscaping's not nice, he's put off some repairs, some tenants have been in there for 15 years and as a result they're paying below market rent, or for whatever reason this building is not optimized. Those are attractive opportunities for us because we acquire them at very attractive valuations, and then it's up to our property management division to manufacture returns by managing the property professionally, turning over tenants, renovating units, fixing the landscaping, putting in amenities, whatever the case may be. Every project, every building is different, right? But if you can do that, if you can add incremental increases to revenue over a building over time, the value of that building goes up. And it's gonna go up whether interest rates are at 2% or at 2.5, right? And so we can manufacture returns at Equiton with our strategy somewhat agnostic of where the market direction is headed. And I say somewhat because if interest rates go up 9%, every building's gonna lose value, no matter how hard we try. But ours might go down 4% instead of 15%. Does that make sense?
There was I could just butcher this, but Informa partners with another company, I can't remember now, oh, it's Cushman Wakefield, I believe, that does tenant surveys. And this most recent one, they surveyed sort of the Canadian tenant marketplace about what amenities would you be most willing to pay for, and they have this giant data set, and maybe you guys participate, the landlords sponsor it, so they get access to
Yeah,
this
for
tenant
sure, we
data.
want the data, it's useful
Yeah,
for
you
us
use
as
the
well
data.
as
One of the things that came out
property
of that I thought was the most interesting is that one of the biggest cost-effective investments in your apartment building to increase rents is plants in the lobby. They discovered that if you just put a couple plants in the lobby, people will pay an extra couple $100 a month.
Yeah.
This is a beautiful place, look, they've got plants in the lobby,
Yeah.
I'll pay more
It's,
this year.
it's,
right?
it's the institutional apartment building equivalent
does.
of curb appeal.
Yeah,
And
exactly.
it creates a nicer sense of community, honestly, it really does. It's little things like that. Also on that list, ensuite laundry. People
Yeah.
do not want to go down to the basement of their apartment building and do laundry,
Yeah.
right? If you can put in a tiny condo-sized unit for $2,000 or $1,000, that is gonna pay for itself in 10 months,
Yep.
right? And then the rest after that 10 months is your profit. So these are little ideas that we use to find creative ways to drive value of our buildings. Yes?
It's just a question about the geography when you're talking about where you guys invest.
Mm-hmm.
So it seems like there's more migration towards the west because you get better yield, right? And that's where in GTA area it's harder to get yield nowadays. So I guess
Well,
my
that's
question.
changing now, but
Yeah, but my question is, yes, I want to hear you guys' comments on that. Is what would be the benefit potentially to invest something in GTA, given that the yield is potentially lower? Obviously, understanding on the west is easy because you get better cash flow, get better cap.
Yeah, you also
But
got
what-
7% vacancy there, 0.6%
Yeah, yeah.
vacancy here, right?
Correct.
So-
But I mean, I guess the vacancy still able to the return is still able to offset the vacancy discount there.
yes.
But yeah, I'm saying in Toronto, like what would you, or GTA for example, so if their apartment come up and sell, obviously the cap rate is gonna be lower. What do you think is some of the maybe pros per se to argue to invest back in GTA?
Let me take this.
Yeah,
one.
go,
for sure,
please,
for sure.
yeah.
So essentially, what investors looking for is after leveraged net of interest return, and adjusted for risk return. Two things. Leverage. The higher the cash flow or the higher the cap rate, the higher the leverage, obviously, because there's cash flow to pay for the loan. Risk adjusted. Vacancy, consistency of the vacancy, that's also very important as well. Some of the deals that we've done in the past, client goes 4 hours north of Toronto, client goes to Alberta or different parts of the rural area, gets 7%, 10%, 12% cap. But is that realistic? And is that manageable for that individual buyer? Because today we're talking about individual buyers. Right? Not necessarily so, right? If you have the capacity, if you have the management team, by all means, maybe everyone has, but not everyone has that kind of availability. So I would caution, yes, cap rate is very important, but I would caution on chasing only cap rate, because there's a lot more than what's
Yes.
behind the cap rate.
And Lauren's gonna say rent appreciation next. too.
And also
Yeah, I was gonna
development
touch on that.
opportunities too.
Yeah, we actually barely use cap rate as a profitability metric for us. A lot of retail investors do, so we talk about cap rates here, cap rates there.
That's how we land.
Yeah, well, we use IRR, internal rate of return, because IRR, cap rate is just a snapshot of your profitability at a given point in time. It's not across time. IRR allows you, if you're a financial modeler, I can see you nodding, if you're building a model and discounting cash flows, you can capture cash flows across time. And when we buy, for instance, that value add property, so it's underperforming today, I don't care how it's performing today, right? There's a gap to market of 70%. The thing is performing like shit right now. I don't care what it's doing today though, I care what it's doing in the next 15 years, right? That's why I'm buying this building. So IRR as a profitability metric captures that upside across the next decade. Whereas cap rates today take a sliver, right?
I don't care about IRR at all. And this is why, this is interesting. I'm lending money today. I have to assume
Yes,
the rent
yes,
stay
you're dealing
flat.
with facts
I
as it
assume
stands.
expense stay
Yeah.
flat. I assume everything that is today is the only thing that happens in the future. They can project. I mean, our clients, of course, always are going to say, "Okay, my rent's up. I'm
I
going
put in 4 new units
yeah,
here.
I'm
I'm
going
gonna
to
reduce
I'm
expenses.
sub-metering, I'm doing all these great things over time, and I'm going to increase the NOI. Awesome. Good luck. Today the NOI is this. This is what I'm lending on. This is all I care about, which is why we use.
This is
only
why we
capital.
get along.
Just had a question back to the laundry and amenity space you guys were talking about.
Yeah.
When you have an existing building and it has an existing laundry room, do you guys close that off and then add in-suite laundry, or do you guys? I thought there was a
If
rule
we-
where you had to keep it though.
So I'm not certain if there's the rule because I don't work on the property management division, so I don't want to misspeak. But my understanding in terms of how we manage our assets is in a situation like that, if we can put in more units in that space, we will. So if it's in a dungeony part of the basement with no windows, then of course we're not going to be like, oh, we can put in 4 extra units here. But in certain layouts, every building's different. Again, we always are trying to find ways to maximize value, and one of those ways is yes, high efficiency dishwashers, remove the wall-to-wall carpeting, get rid of the popcorn ceiling, whatever. But sometimes we're trying to put in new units.
But this is nice. Not
Yeah, this is fantastic. But see what I'm saying? So every building is different, and every building has its own what we call gap to market. So some buildings are much closer, they're tighter on their gap to market, so it's pretty much performing half decent, and we may be more willing to pay a higher price for those buildings. Other buildings we look at, we're like, it's gonna take us 7 years to optimize this thing, because you can't just go in and kick out all your tenants at one time. It's unethical and it's illegal. So it's more of a slog, right? Now we're willing to put in that time, but we're buying this thing as a discount today to reflect the slog that we need to put in.
On
Right.
new build, purpose-built apartment buildings, they're all in suite. Just because
Yes.
people want to feel like it's a condo quality, right? Whether you're building it exclusively for rental, you want to still have that vibe that people are moving into a condo, and so you're not building or laundry rooms. in the
Yeah,
basement.
definitely not.
Yeah,
That's an
days are
antiquated.
over. Yeah,
building
the days of
layout.
like laundry room.
Yeah, I mean, unless you're building maybe in a small rural town or something where it just doesn't make sense because you're not going to get the same increase in rents. But
But it's not
I mean,
like
any
it's
major
not to a
urban
law
market.
where you have to keep your laundry room like operational. Like there's coin laundry everywhere. Like you can close that
Yeah.
down and
Yeah, I've
have
not heard of
tenants.
that. I've not heard
Like
of that.
that's what I'm assuming, right?
Yeah, again, I couldn't speak to it. I don't
So
want
it's
to
more
misspeak
about-
while I'm on camera.
It's a property management question.
We've got 3 minutes left. Do you want to do affordability or development? Where do you want to go for the last couple of minutes? What's more comfortable? What do you think?
I think affordability might be better
Affordability.
just for the audience, unless you guys
Sure,
love
yeah,
development.
any debate? Okay, cool, great, go. Go, affordability.
You go first?
Yeah.
Go first.
Okay.
Let me
Or am I
set
going
you up.
through
Let
my
me
knowledge
set- let me-
Rolodex? No,
let me-
I'm good.
You
I'm
good?
Yeah,
Okay,
so,
okay.
affordability, obviously, that's defined by interest rates when we're talking about real estate, right? Because a higher interest rate, all things being equal, is going to increase the carrying cost of whatever asset you're purchasing, right? Now, on the Equiton side, for us, this is a really good thing, because think about it intuitively. If you are a potential new home buyer, and now you're seeing interest rates go from what you could have got a variable rate mortgage as low as 1.4% maybe, and now you're walking in the door at 5.5, well, you're gonna put off that home purchase, right? And if you're gonna put off that home purchase and you're currently renting, well, that's gonna keep you in the rental market. So the overall output to that is we're seeing increased demand for rental units, right? Because new people are entering the rental market, and those that are still in it aren't necessarily exiting. And so we're seeing a buildup in demand for rental units, and that's exactly what we're seeing happen in the market. We're seeing rental rates stay high. Now, part of that is because landlords are demanding a higher return because their carrying costs are going up, so they need things to be worth it for them. But it's also because if you're a potential home buyer, you don't really have a choice. You're kind of stuck. So that is actually a good thing for our rental strategy. And it's important to talk about that through looking at it through an affordability lens, because a lot of conversations I have with people, they see the news headlines of, oh, interest rates are high and therefore single family home prices are falling, and they say, how can you offer an investment that's never dropped in value? Every news headline I'm reading is real estate prices are falling. And the answer to that is not all real estate's created equal, right? A commercial asset is valued primarily as a function of the revenues it brings in. And if I just told you that there is a very high demand for rental revenue, and I also just told you we have, generally speaking, 10-year fixed loans, so our carrying cost doesn't move, Well, when interest rates go up, our interest expense stays the same, all things being equal, but our ability to charge higher rent increases. So there's a net positive there, right? And there's just one simple example how just because you're seeing rising interest rates doesn't necessarily mean there is an opportunity out there, right?
Okay, so I'm going to twist a little bit into commercial real estate, not just on the residential apartments, but on the industrial side. So the way how we look at it is, what is the rent that client is currently paying per square foot on the industrial property versus how much they're going to pay for in terms of buying, and also what is the future outlook of industrial real estate supply in the GTA area versus its demand. First, on supply and demand, there's no more land on industrial properties, right? There's actually even lesser land because some of the lands are being converted to commercial or even
Yeah, these
residential.
are becoming residential areas.
For
Our
the
condo
moment.
development is it used to be an industrial area.
Exactly.
Now it's gentrifying.
Exactly.
right?
Now, on the supply of it, is there more supply or is there less supply in industrial? So first of all, we talk about COVID, right? During COVID, there's a lot of e-commerce. And also, another way to look at supply is, supply of industrial storage space or warehouses is actually a function of the overall population growth. Is GTA growing? I'd be able to say it is, right? So if there's more people growing, more people coming to GTA, there's more demand for goods that they consume. There's the storage need for it. So on the supply side, it's positive. On the demand side, it's positive. And then on the rent, it has to go up, or it has to stay at least very stable. It has gone on significantly since, I think, 2019, probably
Yeah, it's
almost
been
double.
ripping upward, yeah.
Right.
More than double, $6 to $20, so
Yeah.
tripled.
I was going to say 9 to 20, yeah,
Yeah,
okay.
yeah.
Yeah, and also on the purchase price per square foot, it has also increased significantly. Some places more than double, right? So on that perspective, what is the future going to be? Affordability because of interest rate, I think it's going to normalize or stabilize. I don't think the trajectory of the last 2 or 3 years is going to be, was like this. I don't think it's going to continue like that. I think it's going to slow down. But how low it will be, that's the $1 million question because it depends on how high the interest rate is going to continue.
And it's different for each asset class, right? Like an apartment building is not the same as an Amazon warehouse, right?
Exactly.
So everything is kind of a little bit different, for sure.
Karen, final thought?
Yeah, I have a follow-up question regarding
Yes.
your industrial and the financing. So for these owner-occupied buildings, because right now we are in a high interest rate environment, right? Do you see the trend that more owner that may choose to sell the building and lease it back as a tenant, or they want to do like a refinance?
I think this is a great question. There's a divergence of that. It depends on their actual operation. We see there are some clients who are exiting the real estate investment themselves, yes, sell and lease back. But also we do see a lot other clients who benefited from COVID and are still doing well, and they're continuously to buy more because they think industrial real estate is a stabilized pricing asset or investment opportunity, so they continue to buy more and more. So
Even
there's
from
two.
oh, sorry.
Yeah, so there's two sides of that.
What about from an owner-operator?
Yes, owner operator.
They also? Oh,
Yes.
Thank you.
Yeah, on affordability, I'll just add, I mean, it's clearly a supply issue, in the major urban centers across Canada, predominantly Toronto and Vancouver. The current interest rate environment, COVID, all that had major impacts on the supply. I would suggest, we don't have time to do it now, but if you do, go and Google MLI Select, MLI I don't know what it stands for. Anyway, MLI Select is a CMHC program for affordability. That program is the only reason that there's still construction of apartment buildings happening right now, right? I mean, I think something like 88–90% of every unit being built in Canada is financed through this MLI Select program because it offers higher leverage, discounted fees, it allows you to term out your mortgage before rent up, so you avoid any leasing risk, allows you to lock in your interest rate. There's a whole bunch of attributes that otherwise the development community would have just said, you know
We'll
what?
just build condos.
Yeah, we'll just build condos and/or it's not even worth building. Because with condos, the problem is you've got to go long the project before you even fix your sale prices, right? Like apartments at least get you some, like the example of, if you have a delay, you might even skate into a better deal because of the rent at the end. That MLI Select program is the only reason. That's a federal government program that's come out. So I mean, if you're looking for one reason to be proud of the federal government, there's it, right? They're helping finance 10 to 15,000 units across the country right now, and without it, we'd be in a way worse position than we are today.
The question is 10 to 15 units a year enough?
No, it's not. No, I think the
And-
number is
and either-
150,000 we need to build,
Yeah,
right? And they're building
easily,
10 or 15,
easily.
right? So
Yeah.
it's still, but
Yeah.
it'd be zero
It'd be zero.
if it wasn't for it, right?
And
So.
you know what else isn't helping as well? Scaling back the green belt 15 acres. Not really gonna help as well either.
Yeah, none of, I mean, it's.
Well, you're
it's-
building, it's low density residential, right? So you claw back the green belt, but then all these people are gonna have 200-foot wide, or not 200-foot, 90-foot, 80-foot wide lots, right? So you're not building a 25-story condo in Nobleton. It's not gonna happen, right? So there's no density.
Let's finish on this. I'll say this. One of the biggest challenges to development in Canada is NIMBYism, right? Is not in my backyard. So if you are
Great point.
in a neighborhood that's got beautiful backyards and big treescapes and there's development going down the street, go to the community meeting and advocate for that development, because who shows up are the 80-year-old white hairs that live in that neighborhood for 50 years and go, I don't want these, this 60 units at the end of my street, and that's the reason we're not building enough. So.
Meanwhile, 80% of Canadians will agree that we have a
The
housing
environment,
supply
yeah,
shortage.
just not,
or
just
maybe more
not,
than
just
80.
not at the end of my
Yeah,
street.
but not here.
And then
No,
someone
no,
else's,
you're crazy.
right?
We
Yeah.
didn't touch on migration too. That's another factor.
Well,
Yeah.
exactly, right? The amount of migration into this country is, I mean, it's astronomical, right? So it was 100 million in
Well,
2030 or 2050
the
or something
Trudeau
like that?
government's mandating 1.5 million new immigrants over the next 3 years, about 500K per year. And ask yourself where these people are gonna live, right? In economic centers of our country. Toronto, maybe Vancouver, not Montreal, because there's a language barrier, so it's pretty much gonna be Toronto and secondarily Vancouver.
Yeah,
So,
40% of Toronto.
there you go, 40% of
yeah,
Toronto.
there you go.
Okay, I think that's enough. Thanks, everybody.
Yeah,
Thank
thanks,
you.
guys.